Um, Hi, I'm Christina Ritchie. I work for Americans for the Arts. This session is called Combating Losses from the Charitable Tax Deduction Shift. There are 3 stated learning outcomes for this session as follows. Learn more about changes to the tax law related to charitable deductions, hear about likely behavioral shifts from donors and how organizations can respond, and learn about available resources for learning more about this issue. As a reminder, and you've heard this reminder all day, I'm sure, Americans for the Arts policies related to accessibility. First, we at Americans for the Arts believe that amplification benefits everyone and that no one should need to request that someone use a microphone in order to be understood effectively. As such, we have instituted a policy that anyone who is saying something that is meant to be heard by the entire room must use a microphone. In that same vein, please refrain from side conversations as they are disruptive to your fellow attendees and can keep them from fully hearing the session content. If you are going to ask a question at any point, Susan will help us with the microphones for that. So with that, I'm going to introduce our first speaker, Dave Ratner.
Good afternoon, everyone. Let's see, do we know how we are starting? Let's see, I think this one. There we go. I'm Dave Ratner. I am an attorney. I have a law firm called Creative Law Network. We focus on supporting artists and arts organizations. We work for creative people and businesses. And pleasure to be here with y'all. Thank you for being here. Thank you for coming to Denver. And what I'm going to do today is just lay out an overview of what we're talking about so that it'll be followed by Renee and Christina with a little bit more detail. And I think what we're going to do is have all 3 of us give our presentations and then open it up for questions afterwards, so you can save questions till the end. So what we are talking obviously about today is losses from the charitable tax deduction shift. And so this is basically about, I'm sure all of you remember very well, the tax bill that was passed last year and the tax reform that resulted from that. Took effect on January 1st of this year. Lots and lots of changes from that bill. We're not talking about all of it, right? We're only talking about one area, which is the charitable tax deduction. So basically, the overview, I mean, everybody in this room, everybody watching on the live stream, we all pay taxes, right? So I'm going to start at a very high level that everyone's going to understand. We don't know what everyone's level of understanding about charitable deductions are, so we're just going to kind of drill down as we go. And the idea, basically, I think everyone, like I said, in this room understands we pay taxes. We pay taxes based on our earned income. And so the difference, though, I think most of you know, you don't actually pay taxes on the exact amount of your earned income. You pay taxes on a taxable income, which is hopefully a lower number, right? And so we deduct certain expenses from our earned income to result in our taxable income. So basically, there's a bunch of deductions that the average American can use to adjust their taxable income lower than their earned income, and the charitable tax deduction is one of these expenses. So other examples, you can deduct your mortgage interest, right? You can deduct state and local taxes. You can deduct medical expenses. If you're a small business owner or a business owner, you can deduct unreimbursed business expenses, and you can deduct donations to charitable organizations, to nonprofits. So basically, the idea is people will make contributions to lower their tax bill, to increase the deductions, lower their tax bill. The charitable contribution or the charitable deduction has been around for 100 years. This is nothing new, and it is not going away. It's not that has been taken out of tax policy. It's just that the way that we calculate it, or the way that the average American calculates their deductions and their charitable tax contribution, is changing. So there's basically 2 ways that you can calculate your deduction from your earned income to your taxable income. And these 2 ways are itemized or the standard deduction. So basically the itemized deduction means you take all of these things, you itemize them, your mortgage interest, your expenses, your medical expenses, your charitable contributions, and you itemize them out, you get a total, and that total you can deduct from your earned income to make your taxable income. The other option is what's called the standard deduction. The standard deduction is just a flat amount. So no matter what your expenses are, no matter what you contribute to charitable organizations, you can deduct that same standard deduction. And basically, the idea of having itemized deductions is it encourages people to itemize, to contribute more and get more than that standard deduction. So the reality is, the average taxpayer is going to choose between the itemized deduction or the standard deduction. They're going to choose whichever is larger, right? They're going to try and deduct as much as possible. So if the total amount of their itemized deductions is greater than the standard deduction, they'll choose to itemize. But if it's less, they'll choose the standard deduction. And obviously, we all know that when as charitable organizations, we try and generate donations, one of the reasons we say, hey, you can donate, it's tax deductible. It decreases your tax bill. So it's a major incentive for people to donate to nonprofits, to charitable organizations. So the change that we're here to talk about, really, or rather the change that has, I think, motivated this conversation, is the change in the standard deduction, what that amount is. So what I've done is just held up what the standard deduction was before the tax bill and after the tax bill. And as you can see, the amount has almost doubled, regardless of what type of taxpayer you are. Your standard deduction is now drastically higher, extremely higher. And so the concern here is that this will increase the number of people who are going to take the standard deduction, decrease the number of people who will take the itemized deduction. If people aren't itemizing, they're less motivated to contribute, right? Because they're less motivated to add to those expenses. They just say, well, it doesn't really matter. I'll just take the standard deduction. And what I think the big difference is going to be is that the motivation is going to have to come from not have to, but we have to add other incentives to folks for making charitable contributions, because a lot of folks may not be itemizing anymore. And we want to make sure people still see the benefit of charitable deductions, even if they're not itemizing. We still want to encourage that behavior. The change, obviously, we haven't gotten there yet. People haven't filed their 2018 taxes. We don't know what is going to occur. There's been predictions. Again, we're pretty certain that more people will choose the standard deduction. In the past, it's been about 30% of taxpayers have chosen to itemize. The estimates are dropping that number to as low as 5% of taxpayers will choose to itemize. That doesn't mean that it's going to be that big a difference in the amount of contributions we get, but it does mean that it's changing the way people think about their contributions, think about what motivates people to make charitable contributions. So that is the adjustment we're thinking about. It is not all bad. Okay, there's bright side to this as well, and it doesn't mean we're all going to, every charitable organization, every nonprofit is going to see their their contributions decrease. One thing is, a lot of taxpayers don't really understand this, and hopefully, people are motivated because it's a good thing to do, right? We hope that people make charitable contributions because they're supporting an organization, they're supporting a cause, they're supporting people, their community, and so hopefully that doesn't change it very much, but some people don't really think about, how does this affect my bottom line? They're doing it for other reasons. Another thing that came out of the tax bill, a lot of the news was reporting that wealthier individuals in the country will actually have a lower tax bill due to the tax reform. And so we can hope that wealthier individuals will now have more disposable income. And with more disposable income, hopefully they'll be contributing more to these same nonprofits. So that can be a bright side, as well as corporations. We certainly know that the corporate tax rate was decreased significantly by the tax bill. And so we're hoping corporations will have more money left over at the end of the year, will have more money to contribute to support nonprofits. There is something called bunching. So basically bunching, it means that donors can contribute multiple years of donations into 1 year. So basically, if you're going to say, I'm going to donate X amount over the next 2 years, donate it all this year, take the itemized deduction. Next year, you don't donate, and you take the standard deduction. So for organizations, a strategy change might be choosing to offer a 2-year membership, for example. Instead of a 1-year membership, people have to contribute every year. You offer a 2-year membership, they contribute a lot in 1 year. They don't contribute any in the next year. They can itemize in that first year and take the standard deduction in the next year. Another bright side, or another way that this doesn't necessarily damage or decrease contributions, is through donor advised funds. So if people are forming donor advised funds, they can contribute a lot to the fund in 1 year, take the itemized deduction, and then distribute out of that fund in subsequent years and take the standard deduction. So it's basically, the idea is people will say, well, I'm going to donate to nonprofits this much over the next however many years, donate it all at once, and then distribute it over time through a donor advised fund. And the one other thing that I think that is a bright side here is that the change in the tax law also allowed, it increased the maximum allowable deduction. So basically, the percentage of your gross income that you can claim as a charitable contribution was 50%. It is now up to 60%. Most Americans probably don't contribute 50% of their gross income to charities. We wish they did. But for those that can afford to do so, they can actually increase that now to 60%. So that may provide more benefit as well. So that's just the overview of the change that has happened, what we expect the results to be. And I'm going to turn it over to Renee Fagan to pick up from where I left off. Thank you very much.
And what button do you push for? I'm not the wizard of starting PowerPoints.
No, here's.
Thank you so much.
No, we're good.
There you go, slideshow. Okay, great. Appreciate your help. All right. Good afternoon. How's everybody doing? Thank you for attending the session, first of all. So I'm Renee Fagan. I'm the president and CEO of the Colorado Nonprofit Association, and we do a lot of advocacy work, both at the federal and state level. And so Dave gave a great overview of the actual details of how this works, and I'm going to apply that to Colorado and give some suggestions about how you might also do the same analysis in your state, and then talk about a couple things that Colorado has to help increase charitable giving and potentially mitigate any differences that may occur as a result of the federal tax reform. So just for a second, the Colorado Nonprofit Association is a state association. We have about 1,300 members statewide. A good percentage of our members are arts and culture organizations. Meredith, who's seated over here, is with the Colorado Business Committee for the Arts, also in a shared space collaborative we have. So welcome, Meredith. Thank you for being here. Thank you for getting me here. So we do, as I said, a lot of advocacy work, but also provide knowledge-based resources to nonprofits to help them solve problems in for their missions. And we belong to the National Council of Nonprofits. There are 38 state associations like ours. So I wanted to start with this slide, which is a little bit old data now. It's almost probably, this data is from 2012, but I think probably the proportions are a little bit the same, because when we talk about federal policy in particular, it's good to see how that variously impacts different kinds of nonprofits according to their mission. So there's a lot of numbers up on the slide, but you can see on the far left side that this is a percentage of these sectors of nonprofits that receive their money from private donations, private payments, government grants. So Arts and culture and also environment and animal protection organizations receive a greater proportion of their revenues from private donations. That second column, private payments, education, healthcare, that kind of makes sense because they're getting fee for service. So the tuition for schools or insurance reimbursements, also arts and culture, I imagine private payments might be museum entry fees or something. And then the government grants and payments, healthcare and human services are more related to that. So when it comes to things like federal appropriations or state appropriations, healthcare, human services would be more greatly affected, whereas when we're talking about donations, particularly private donations, arts and culture is among that sector that is affected. So Dave mentioned a little bit about donor behavior as it relates to tax policy and tax incentives. And so in 2014, the Colorado Nonprofit Association did a statewide survey of Coloradans' beliefs and behaviors of charitable giving, and we asked lots and lots of questions, but one of them was, do you consider tax benefits when you are making a donation? And as you can see, 50% agreed that they do, particularly those with more upper incomes and also those who gave more. So for a certain kind of donor or also a donor who's giving a certain amount of money, tax policy is one of those things that will drive a decision. It's not driving the decision to donate to begin with, that's motivated by the cause, but the amount of a donation for tax purposes is a factor for Coloradans. So Dave gave a really good overview of what the new tax law did, and I really appreciated his calm, methodical approach to what's the standard deduction and what's the itemized deduction. I was talking to a group from Tajikistan, who was in the United States, looking at different nonprofit organizations and try to translate. I was explaining what the Colorado Nonprofit Association does, like advocacy work. And here's what we're working on. That translator was really having a hard time with standard deduction, itemized deduction, not to mention, I don't know what Tajikistan stands. So I was like, well, I'm trying to explain this, but it wasn't working. Dave, on the other hand, did a fabulous job walking through this. So as you said, the main thing here is broadening the standard deduction, fewer people going to itemize. I'm going to come back to this universal deduction in a second. But here's the main impact. So again, a slide with a lot of numbers, but this is Colorado's profile for Coloradans who itemized in 2015. And this includes the charitable deduction. So total is $3.8 billion of charitable deductions. That's the lower right-hand corner. This, again, is only about the third of taxpayers who itemize. The kind of yellowish gold bar in the middle is the income group, 100 to 200,000. You can see that red number in the second column from the right where it says 23,744. That's their total deductions. So as Dave mentioned, that's mortgage interest, state and local taxes, if they have health deductions, and their charitable deduction. So that group, if they're joint filers, they're right at the cusp of whether they're going to have to itemize, because if their itemized deductions are under 24,000, it doesn't benefit them to itemize. So that one group alone was 25% of $3.8 billion, or $985 million, just that one group. So everybody below that, or I should say above that on this chart, will no longer need to itemize. That group from the yellow on up is $1.7 billion, or half of our charitable deductions. So those are the folks that are going to be deciding, do I need to itemize or not? So I always say they're not going to stop being charitable. $1.7 billion isn't going to go to zero. But to the extent that they wanted to reduce their their taxable income and increase their charitable deductions, that group will no longer have that incentive. So about half of our taxpayers and half of the deductions. So one of the good things about Colorado is we're pretty high up among states in personal wealth, and our upper incomes are extremely charitable. So our top 3% are giving $1.3 billion of charitable deductions. So almost a third of that $3.8 billion, which is really great, and they are going to continue to itemize. And as Dave said, they can give even more, up to 60% if they want to, or anybody could, I suppose. So this is, again, there's a lot of numbers here, but this really shows the dollars and cents of how this could impact Colorado. And the way we gain this slide is the IRS, the Internal Revenue Service, publishes the statistics of income, and it's usually 2 years in arrears. And they do that for every state, and when you pull up your state, it lists every single line on the 1040. And we'll have, and then it's broken down by these income categories. So what this does is we just went to the deduction lines and the charitable deduction lines and just did a lot of spreadsheets to get these percentages and all. So I would encourage, if you're interested in this or have an advocacy organization in your state that's interested, to do that kind of analysis. When you start plugging it into the spreadsheets, it's not really that difficult to figure out the percentages and the averages. But every state's profile is probably going to differ according to your donor behavior in your state and also the income distribution in your state. But for us, as I said before, about half of our charitable deductions would be affected by people no longer needing to itemize. So I mentioned, just kind of glossed over the fact that during the Tax Reform Act, there were two bills that would have basically allowed people who weren't itemizing to still itemize their charitable contributions. So it's called the universal deduction. And those bills had caps of the total. Basically, it was you could deduct up to a third of the standard deduction of your charitable deductions. Okay, so there was like a cap, not everything. But in our state, again, that would be fine, because if I can get the pointer to work here, can't. You can see that break point, the yellow mustard colored line, the average charitable contribution is $4,000. So that would have been great for us. That would have brought back everybody who now didn't need to itemize would be able to itemize with that universal deduction and the cap. So currently, the charitable sector is pushing to have a universal deduction again, both for everybody, no caps, and also I think there is one bill on the cap. But it's going to be a real challenge, because bringing back the charitable deduction for everybody will basically reduce money that's going into the Treasury, U.S. Treasury, and so that is probably not a direction that Congress is going to want to go. I mean, they've already $1.7 trillion down for the way the Tax Act worked, so it's an uphill battle. But there is legislation pending, and the charitable sector is supporting the adoption of that to, again, mitigate the changes that were occurring in the federal law. So how this affects, as Dave said, I think, and as Christina is going to talk about, is really up to us, whether it's a time of transition of how we appeal to donors. So I wanted to close my part with a couple things that Colorado has and Colorado will have to encourage charitable donations. So in Colorado, since 2005, we've had a state deduction for non-itemizers who donate over $500. And the way that the deduction works is the amount over $500 you can deduct. And we have a 4.63% as our state income tax rate, so we have a single rate of our individual income tax. So it's worth essentially 4.363 cents on the dollar. So in 2015, as you can see here, 155,000 Coloradans took advantage of that. Their tax savings averaged about $72, but they gave $234 million associated with that. So that's, and these are non-itemizers. So that's not in the slide I showed you before. These are people in addition to that are giving. So we have this in Colorado. The association was a main driver of this in 2000. It started before 2005, actually, and we made it a permanent part of our tax law in 2010. And there was a bill at the legislature this year to basically lower the 500 to zero. But that didn't pass because of the impact of broadening the deduction, reduced state revenues, and the legislature couldn't afford that this year. So I think it's Minnesota. Anybody here from Minnesota? They, I think, were either looking at this or have this too. So this would be an alternative to have your own state non-itemizer deduction against your state taxes. Another thing that we did in Colorado this year was spearhead this bill, which is called Donate to a Colorado Nonprofit Fund. So basically, this has to do with state income tax checkoffs. So 41 states have some kind of a way where taxpayers can direct their refund to usually a very specified list on the income tax form. We today in Colorado have 20. To get on that list, a nonprofit organization has to pass their own bill, has to have their own law to get on that list, and they have to meet a minimum amount of donations each year, which is $50,000. So what our bill does is basically take one of those lines and will allow a taxpayer to go to the Secretary of State's list, and any nonprofit that is registered with the Secretary of State to solicit funds in Colorado for more than 5 years, so they're 5 years old, is eligible for the taxpayer to designate them to direct their refund to. So this really is going to broaden the choices that taxpayers, donors have in Colorado, because I'll show you a slide here in a minute, there's thousands, thousands of nonprofits. Basically, it's going to start in 2019 because we're going to raise money to pay for the Department of Revenue setup costs. So in our state, if things cost tax dollars, they usually don't get passed in the legislature because the legislature is funding schools and higher ed and human services and housing and everything else. So we modeled this kind of after like a federated giving campaign, like a United Way, where the federated giving campaign takes a percentage of, or their actual costs out of the donations. So over time, that's what will happen. The revenues, administrative costs will come out of the donations, and the setup costs will be paid through gifts, grants, and contributions. So that's why it's going to start in 2019. But here's the impact on it. So last year, there were $1 billion of refunds in Colorado from over 2 million returns. So just 1% of $1 billion is $10 million. That's hardly anything for if taxpayers either just give a little bit or just a few taxpayers give something more than to the 20. The 20 on the form got 1.9 million. So here's that slide. So this is all of the income tax refunds. The red is a really big day we have in Colorado in December called Colorado Gives Day. $38 million came in last year for Colorado Gives Day. That's only 4% of $1 billion. But $38 million is a lot of money. That's a lot of money. And that little itty-bitty sliver, you can't even see it, is the current checkoff amount. So there's a lot of capacity here, a lot of opportunity for nonprofits to be appealing to their donors during the tax season, starting in 2020, and try to get a share of that pie. And again, it doesn't have to be much to add up to millions of dollars for nonprofits. So those are two things that we've done in Colorado. One is have that state non-itemizer, and the second is this donate to a nonprofit fund. So with that, I will turn it over to Christina. Okay. I just let you close it.
No, that's fine. That's fine. Where's what has happened here? Was I not supposed to press that? I'm just not seeing the cursor. Oh, there.
Yeah. That's got it going right there. You go.
Thank you. I've lost it again. I can't.
You want to try?
Yeah.
It does keep disappearing. Yeah. You're right, it's gone. There we go. I'll try here.
Okay.
Open yours.
Okay. All right. Now we are somewhere. Okay. Technology. Yes. Hello. Okay, so I'm Christina Ritchie. I'm Director of Individual Giving and Americans for the Arts. We've been working on this issue for a while. As you probably know, the preservation of the charitable tax deduction is one of the three core federal issues that Americans for the Arts advocates for on behalf of the field. And since the tax bill passed, we've also been focusing on how we can serve our members in understanding what do we do about this now that this regime is in place. And so that was some of the motivation behind this session today. There's also a very long blog post on Arts Blog, and I'll link to that, that blog post later in this presentation, and when you download the slides, you can get to that. We've done a member briefing call, and we'll be looking at doing some webinar content that'll be archived on ArtsU that you can access also. And we're always here for you to call and ask questions, so I'll say that right up front, and I'll say it again at the end. So what do we do? How do we engage donors now that we're in this world? The first question that everybody has is, what will the donors do? And the answer is sort of course, we don't really know. We can speculate, we can look at the numbers, and both of these gentlemen had great slides for us about sort of what people have done in the past and what we think that might happen in the future. But we're not sure. We know that in past years when tax reform bills have passed, we've seen a spike in charitable giving the year before a bill passes because people sort of understand what the picture looks like in that year, and then they drop the following year and then they recover. So we can hope, in a sense, for that. Not that anyone wants to see a drop in 2018, but certainly not a permanent drop. But we don't know. We try to guess. I've heard from some people, our donors tell us that their donations aren't dependent on the tax deduction. They believe in us. They're going to continue to give. Does that mean that we're safe from the impact of the tax bill? I hope so. Probably not. We know from many other contexts that what donors say they're going to do and what they actually do at the end of the year, at tax time, when they're pulling out their checkbook may not be exactly the same. And that's not nefarious. Intentions are generally good, but it's not always reliable to count on what people say in their moments of sort of best intentions. And as I said, the historical data sort of bears some of that out also. So knowing that, how do we talk about this? Because again, we can ignore it or we can say something, and what do we say? So a couple of sort of common questions and themes that are coming up. Our donor brochures indicate the tax deductible amount of the donation at each level. Do we need to change this? As Dave mentioned before, no. The charitable deduction has actually not gone anywhere. It was always true that that sort of tax deductible amount on your donor forms was always subject to whether or not they were itemizing and sort of what their individual tax picture looks like. That hasn't changed. You don't need to make any changes on that front, but just something to kind of keep in mind. Should my organization include language about the tax bill in our fundraising appeals? So there is disagreement on this question among the field of fundraising professionals. And one of the sort of things that prompts this question, and certainly prompted this question quite a bit from some non-professional fundraisers in November and December 2017 was, I just got an email about the tax law from my university imploring me to give right now while I can. Should we be talking about that too to our donors? I would say two things about that at this point in June 2018. One is that message is over now because now we're in the new tax year. And two, there's a pretty narrow set of people who are actually going to be motivated by this, as we saw in that sort of certain slice of donors who might be impacted by the changes in the tax bill. So messaging, in our opinion, messaging to changes in the tax bill as a component of your fundraising appeals probably isn't going to be your most compelling message. Americans for the Arts really has taken the position of agreeing with the Association of Fundraising Professionals on this, which is that the best argument in this new environment is to stay positive and stay focused on your message, stay focused on your mission. It's not a very sexy answer, but truthfully, donors are going to give because they want to give. The amount they give might be impacted by the tax bill, as Rennie said, but your best chance for maintaining those donations is still always going to be your core case for support. So in general, that's what we think about your broad-based fundraising appeals. But there are two major exceptions to these conversations. One is your planned giving newsletters, and the other are major donor visits. So if your organization or the organizations that you serve have a planned giving program, and when we say planned giving, we're talking about sort of more complex donor vehicles that include things like bequests and trusts that you may have heard of, but also sort of more sophisticated giving vehicles that produce life income, or we can talk more in depth about that if you want afterwards. I won't get into it. But if you're marketing planned giving programs, you also probably have some kind of newsletter and drip marketing that goes on over time. There are a lot of planned giving consultants out there right now that are recommending that you do message a little bit to the changes in the tax law as part of that marketing. It's not a solicitation strategy, it's an education strategy. So the idea that you can provide a service back to those prospective donors by explaining the tax bill as clearly as you can, and the marketing firms that you work with in the planned giving space are experts at doing this, and simply say, you may have heard about this, you may be wondering, here's some information I thought you'd find useful. It's not a solicitation, you're not asking for a response, but it's one way to sort of prove that your organization is thinking about this for the kinds of prospective donors who might be thinking about more complex tax issues in their giving strategies. But no solicitations around this. The other opportunity you have are with your major donors, and major donors are giving a different amount depending on the size of your organization and sort of who you are. But in the instances where, sorry, there's a fly. In the instances where you're having sort of individual conversations with major donors that you know well, perhaps your board members, you're sitting down and talking with them about what their plan is of a major investment in your organization, or even their annual investment, but where you're having a one-on-one conversation and they're thinking about, well, I might change my giving this year because the threshold for charitable deductions has moved from 50% of adjusted gross income to 60%. You know, these are individual conversations where you can start to talk about how the tax bill actually might be to their advantage to give more this year. It's not something that's really necessarily going to resonate to a broad audience, but in those one-on-one conversations, there are opportunities there, whether that's talking about, as I said, taking advantage of that AGI adjustment threshold, or other kinds of life income vehicles that allow them to make a big contribution this year, take a big deduction, maybe take a standard deduction next year, but have life income from that gift. But those are, again, all kind of pieces that you're going to really be working with one-on-one with a donor as opposed to in a marketing environment. So giving techniques and vehicles that donors may use or ask you about. And Dave touched on some of this a little bit, so I'll skip the parts that he covered. Bunching is something we started hearing about a lot at the end of 2017. We're hearing in 2018. The key here really, and the key with all of these things, is to make your donor's life easy as much as possible. If these are techniques that they're trying to use, this is your opportunity to make it very simple for them to understand how to support you in a way that also works for them. So one thing may be, you know, if you're in the arts, we like to offer lots of donor recognition benefits to our supporters, whether that's access to a patrons lounge or member preview nights, or you know, ticketing priority, other kinds of things, and that's usually very annual membership based. So if you can actually start making it very easy for people to understand that yes, you could have a 2-year membership. Of course, you could do $2,000 this year and $2,000 next year, or you could do $4,000 this year for a 2-year membership. Sort of building that into some of the language and materials that you have that are available to people makes it easy for them to communicate to you what they're trying to do when they make that gift. So if they're writing you the $4,000 check, is their intention to upgrade their support to $4,000 this year, or actually to give you $4,000 this year and nothing next year, with the intention of sort of smoothing that $2,000 a year over time? That benefits both of you, because what you don't want next year is a surprise that that $2,000 you thought used to come from this reliable donor every year isn't coming. The other opportunity that you have with bunching is, many arts organizations, although not all, have a mid-calendar year, fiscal year end. And so if you have organizations that are individuals who are looking to make contributions, bunched into one year, you can make that work for your fiscal cycle by essentially asking them to give once in June and once in July on either side of the end of your fiscal year. It helps you smooth some of your accounting and some of your resource needs, and also accomplishes the donor's goal. So not going to work for everyone, but another way that you can make your donor's life easy. Donor-advised funds were mentioned a little bit also. If you don't know what a donor-advised fund actually is, you can think of it as a family foundation or a private foundation without all the administrative burden on the donor. So essentially, donors pursue donor-advised funds through sometimes your community foundations, often through private organizations like Fidelity and Schwab, to get the benefit of having what used to be established as a small family foundation through more like a banking relationship. And it's really very easy for them to pay into this fund, take their deduction, and then pay out of the fund to charities that they want to support on whatever schedule they choose. So there are the way that you can make your donor's life easy, again, in working with donors who give through a donor-advised fund, is to just know how it works. So there are some rules for donors who are giving through a donor-advised fund. One is that they cannot receive any goods or services in exchange for their gift. So going back to that conversation about donor benefits for our arts donors, because the donor receives their charitable deduction from a donor-advised fund gift when they pay into the fund and not when they pay out, they've already received a deduction for that full amount, that full $4,000, when they paid in. So when they pay out that $4,000 to you, there can't be any non-deductible amount to that gift. So they can't receive any benefits for it. And the IRS is pretty strict about saying they also can't write you a personal check for that $200 of non-deductible portion and still get their drinks in the donor lounge or whatever it is. It really has to be a purely deductible gift. They can't use it to buy gala tickets, for example, because there's usually a substantial non-deductible portion of that. So just knowing those things in advance, when you see those checks coming in from a donor-advised fund, you already know how to handle it. It's going to make your donor's life a lot easier because they don't have to explain it to you or correct your documentation on the other end. It's good to have some protocols in place for knowing how to handle those gifts. So another piece of that, in addition to not being able to accept any goods or services, is you're also not supposed to issue a tax receipt back to the donor for a gift that came from a donor-advised fund. Again, because the tax-related transaction happened when they paid into the fund, not when they're paying out to you. You can send them a thank you letter. You should send them a thank you letter if you have contact information from them at all, and sometimes you won't. Some people use these funds in order to be sort of more anonymous as a donor. But if not, if you know who they are, definitely thank them. Do not send them a receipt. It just causes problems. And the third thing I would say, again, make it easy. There are a couple different vendors out there who will allow you to put a widget on your giving page of your website that will direct the donor into their donor-advised fund portal to be able to essentially send you a grant through their donor-advised fund very easily with your organization name sort of pre-populated in there, and they just fill in they log into their account, they have your organization name in there, they put in their amount, and it's very easy. There's a great vendor, and I'll link to it later in the slide, called DAF Direct that does this. It's a little widget. Not all donor-advised fund organizations that offer donor-advised funds are included in that, but it is free for your organization, so it's kind of a great tool. Another thing that became permanent in the tax law that we didn't talk about too much is IRA rollover contributions. I won't spend a lot of time on this, but basically there's now a permanent, what was a renewing provision in the tax law and is now permanent to allow donors who are at an age 70 and a half, which is the age, where they are required to take distributions from their individual retirement accounts to direct those funds directly to you as charity without having to pay income tax on them. That's now a permanent provision. So again, not a broad-based marketing effort, but it can fit into your plain giving marketing efforts, or when you know individual people who have IRAs that they aren't using on a daily basis for their income. They don't necessarily need it. They're looking to reduce their income tax burden. This is a good way for them to make their gifts. The other opportunity that people have, this was not a change in the tax law, but we may see some increase in this kind of giving because of the other changes in the tax law, are gifts of appreciated securities or other property. So as you may know, if a donor gives you a gift of appreciated stock, not only do they get the income tax deduction for the value of that stock when they transfer it to you, they also avoid the capital gains tax that they would have incurred if they had sold that stock instead and had given you the cash. So this becomes a much more appealing option, in part because even if the donor is not itemizing their tax deduction and their tax return, and they are not concerned about that income tax deduction, they'll still avoid capital gains tax by giving you appreciated stock. So it can be a really good option for a lot of people. So again, this is my constant refrain: make it easy for your donor, have instructions ready when requested for them to transfer stock to your account. Ask them to notify you when they have transferred the stock and how much, not how much it's worth, but like what the shares are, so that your broker knows who the shares belong to when you receive them, so you can, again, thank them appropriately, receipt them appropriately. And it's really not that difficult to be set up to accept gifts of stock. If you're an organization of any, almost any size, and you have regular bank accounts at a commercial bank, they should be able to set you up for this. It doesn't take a lot of resource. Speaking of resources, so these slides will go up on the website later. So I've linked to a couple of different places where you can get at some of what we talked about. The Arts blog post, in addition to having a huge amount of information in it, also has more embedded links at the bottom of it about this issue, where you can kind of get more resources on that. The Association of Fundraising Professionals has a couple of really good pages. The Sharp Group is one of those many wonderful consultants in the plain giving space who's really been writing a lot about this issue, and they have some good resources. And the widget I mentioned, DAF Direct, will also be linked here, so you can check them out and see if you have a place for them on your website. So that's it. I think we can take questions. This is my favorite photo from National Arts Awards 4 years ago. These are dancer and musicians, graduates of Young Arts in Miami. So, Susan's going to bring you a microphone. Yeah, and we have one up here.
Thank you for that presentation. I guess I have two questions. The gift of stock, I understand. Can you also apportion a gift from appreciated real estate sales, capital gains? If you make some money on the sale of real estate, can you give a portion of that to a charity and avoid paying capital gains? Not the whole amount?
Well, not directly. So what you can't do is sell the real estate, give some of the cash to charity, and keep some of it and avoid taxes that way. The way usually it works is if a donor has a piece of real estate that they want to give to charity and also get some income back, is you usually use a more sophisticated kind of trust vehicle. So some kind of a charitable lead trust or a charitable annuity trust, depending on if what they want is life income, or if what they want is to be able to leave some principal to an heir. And that essentially allows the charity and either the donor or an heir to sort of split the difference. But when the real estate goes into that trust, it will avoid other kinds of tax implications of the sale of the property.
Thanks.
I just want to do a brief commercial for community foundations. I'm from the Community Foundation in New Haven, Connecticut, and we work with so many organizations that have small development, one-person operations, don't have a sophisticated development department that can handle gifts of appreciated stock, or someone doing a charitable gift annuity. They don't understand those things. It's okay. Go to your community foundation. They will partner with you, whether or not the money's going into the foundation as a donor advised fund or going directly to the organization as a bequest or a planned gift. I'm sure your foundation will be happy to work with you to do that, so I encourage you to make that relationship.
Thank you, that's great advice.
Rennie, just a follow-up question, or make sure I understood it. You were talking about the Colorado State tax incentive that taxpayers have to opt in to make a contribution on their tax return, their state tax return, and how there's, you said, I think 20 or so entities that are currently listed. Can you just reframe again, or tell me a little more about what those organizations have done to get on that again, the minimum threshold they've met?
So in Colorado, to be named on the income tax form, they have to run their own bill, essentially have their own law that places them on the form. And they have usually their law extends for a certain number of years. So they're going to be on the form for a certain number of years. And they have to, the way it stands right now, they have to achieve a minimum threshold of $50,000 of contributions. They get like a 3-year or two or 3 year grace period to get to that. So what our bill does is all of those organizations who now have current laws in place will stay on the form, and any other organization can still get on the form to be named. So the status quo remains. But what our bill does is to, again, add a line that would allow a taxpayer to write in any nonprofit that's registered with the Secretary of State to solicit charitable contributions, which is like 11,000. So it's a way of trying to balance equity of accessibility to the income tax system as a way to make it easy, as Christina was saying, to appeal and get donations.
Thank you.
Thank you all for being here. The very bitter end of the day. We'll be around if you have any other individual questions, and as I said, the slides will go up on the website, and you can get at some of the resources in there as well. So thank you.